Good evening, everyone. Welcome to our UCI Alumni Homebuyer Workshop. My name is Jason Maida, your host for this evening's class. Really excited to be with you. I know we're just got to the top of the hour, so I know a lot of you are starting getting into class right now. So we'll allow everybody to get settled in. Our run time for tonight's class is just about an hour. So we'll get a chance to kind of condense all this information into about an hour session. This is a very interactive session. So as we get a chance to go through tonight's content, we encourage you to ask questions of us. Myself and my colleague Ken will be taking those questions. You can either use the chat function in Zoom or the Q&A feature, and we'll make sure we get those questions answered for you. We're very proud of our partnership with the UCI Alumni Association. In fact, we've been in partnership for almost 6 years now. This is a class that we teach to alumni about 4 times a year. And we also teach in the international business class, we also teach kind of a segment of this as well, usually twice a year too. So really proud to be a part of the UCI community and to help support you in home ownership. So you may have heard about this class in the past. We've got a chance to help educate hundreds of UCI alum and actually successfully help them purchase homes. And hopefully at some point, we'll be there to help you to support you on your journey towards home ownership. Well, again, my name is Jason. I'll be your facilitator this evening. Not only do I get a chance to present these classes across the country, but also work one-on-one with you in home buying. So after tonight's class, if you're thinking about building what we call as a home buying plan, I'd love to be able to work with you one-on-one to see what home ownership might look like for you. Now, again, this is a very interactive class, and we have some of our agenda items on this next slide, but we're going to, encourage you to ask questions. And I know most of our audience is either in Orange or LA County. And maybe some of us are also in Northern California markets. Our class will be kind of centered around discussions around kind of the overall California market, specific to kind of housing changes and what's going on. So we will talk about the housing market tonight. We'll spend some time looking at interest rates. So I think right now is a really appropriate time to kind of talk about interest rates, given what happened last week, and we'll share more about that in just a minute. We'll also look at budgeting, and we'll talk about how do we budget for home ownership, comparing renting versus buying and what that might look like for us. We'll then move into talking a little bit about credit. How can we optimize our credit score in order to achieve home ownership? We'll look at student loans, how those could impact qualifying for a mortgage and some of the documentation you might need along student loans. Talk about loan programs. We'll look at the different choices you have as a buyer when it comes to loan programs and what those mean to you in terms of the features and benefits. And then we'll talk a little bit about documentation as it relates to assets and income for qualifying. And then finally, talk a little bit about assistance programs and finally the buying process. And so we'll kind of walk you through the workflow of buying. So after tonight's class, you might be interested in obtaining kind of your own home buying plan. We'll tell you how to really start on that path towards home ownership. All right, well, let's go ahead and dive right in and talk a little bit about budgeting. And we think about home ownership. I tell our classes this is probably going to be one of the biggest financial decisions you decide to make, because this is much different than going out and buying a car or making any other type of larger purchase. This is going to be a huge investment, and the fact that we have so many that are joining us on a busy Thursday night to learn about home ownership kind of shows me the importance you put on this kind of a purchase. Well, when you think about buying a house, I think there's really a lot of good benefits that we have to think about that come along with home ownership. Now, there's the opportunity to be able to create better stability with your housing but monthly budget situation. So, we don't have to worry about our landlord that's increasing rents on an annualized basis. The home will hopefully appreciate over time, right? So as my home goes up in value, as I pay down my mortgage balance, the difference between those two numbers is home equity. And home equity has an opportunity to create significant wealth for you. In fact, it can change lives and create generational wealth for buyers. Now, along with home buying can also come tax benefits that you don't realize as a renter. So when we think about owning a home and the benefits come along with it and budgeting for it, I always like to start our classes with a rent versus buying exercise. And so I'm going to work or kind of transition into a calculator that's brought to us by Freddie Mac. And that calculator is going to allow us to do a quick little side-by-side comparison of what it could actually look like if we decided to purchase versus continuing to rent for a certain timeline. All right. So now we've pre-filled in this calculator just to keep us on track for tonight's class. So I know many of us are in different locations around California or in maybe any other markets, but we kind of gave you just more of a realistic snapshot. And then all of our presentation material that we're giving to you tonight, we're going to send that back out over email. So we have everybody's emails from registering for tonight's class. So we'll distribute all of the presentation material tomorrow. In fact, we're recording tonight's class. This class will be up on our YouTube channel. So if you get a chance to do a look back or share it with friends or family, that would be awesome. We'd really appreciate that. So you get a chance to have plenty of kind of resources to take away from tonight's class. So this calculator kind of looks like this. And so we have, first of all, kind of a rent scenario. So we're going to assume that we're renting at about $3,500 a month in rent. And then so those are these different input fields that you see that we have kind of set here. We also have renter's insurance that we want to assume in our equation. And then we have rental increases. So in this scenario, we have rent increasing about 5% on an annualized basis. And then we have the home purchase side of things. So for this buyer scenario, we have a $900,000 purchase. The down payment would actually need to be a little bit more if we jump to 900,000. Would be like a 5% down payment. You're going to learn a little bit more about that in our loan program segment in tonight's class. And then we have estimated property taxes. Property taxes can generally be at times about 1.25% of the purchase price. That varies based upon where we're going to purchase. I would actually argue that we might even move those taxes up closer to, maybe 9,200 a year, maybe close even to 10,000 a year. So if we kind of get that up, that'll start changing a little bit of our equation too. So, but again, I would encourage you to pre-fill your own data points there. And then we have homeowners insurance. We have maintenance costs of the upkeep of the home. So that's on the home side of things. And then we have loan information. And so we'll kind of open this tab. We have an assumption that we're going to do a 30-year fixed mortgage. We have interest rate at 6%. We're going to talk more about interest rates in just a bit. And then you have origination charges for your loan. So when you work with a lender, the lender will have origination charges. Now, one of the benefits that you have as a UCI alum is we actually discount our origination charges. So we actually bring those down by $750 to help make financing that much more affordable for you. And then there's discount points that you can elect to participate in as a buyer. But discount points are additional costs that you pay out of pocket in order to bring down the cost of your interest rate in your financing. So a discount point is usually 1% of your loan amount. And that 1% investment that you make generally will equate to about a 0.25% reduction in overall interest rate. Now, in today's market, we're going to learn about interest rates where interest rates are starting to decrease. It doesn't make a lot of sense to buy points right now unless you really have to, or the market makes sense for the time that when you lock in a rate. But those are choices you can make as a consumer as you're considering purchasing a home. And there's also other settlement services like title and escrow fees. When we think about purchasing a home, there's going to be expenses around down payment that we'll have to save up for, as well as what we call as closing costs. And closing costs can be estimated about 2 to 3% of the purchase price of our home. So those are out-of-pocket expenses that we have to save up for, in essence. Now, the last section we're going to look at is what we call other assumptions. So we assume that our home will basically appreciate about 4% on an annualized basis. When we timeline this out, we're going to say that we're going to be in this house 7 years. So we're going to compare renting for 7 years versus buying for 7 years. And then we have the selling costs of our home. We have comparing that with state and federal taxes. And then finally, the savings rate, we kind of plug that into the equation. So our calculator, if we look at it, is going to give us a payment snapshot. So that's kind of the big place to start, right? So we know rent-wise, we're spending $3,500 a month in rent. So if we consider home ownership, there's going to be a significant jump. So in fact, the jump looks like this. We're going over $6,000 a month in housing expense. So clearly we're obviously buying a $900,000 house. So that's significant. But I think as we prepare for home ownership, we're going to have to make a decision if we can really afford to make that, more than, it's basically almost a triple in our housing expense. But I think the other side of it is the opportunity cost, right? So while we're going to pay more on a monthly basis, the buying opportunity over the course of 7 years is just over $100,000 when we consider appreciation of our home and tax benefits that also come along with owning a home. So, that's what we encourage our buyers that attend our classes to think a little bit more about all the benefits that come along with owning a home that you don't realize with renting, because home ownership can make sense for a lot of buyers. And so I would encourage you, if you have some time, take a few minutes, drop into that calculator when you have a moment, maybe after you get tomorrow's presentation material, and run your own scenario. I think it'll be really an enlightening experience. Well, as buyers are considering to jump in today's housing market, they're looking about what's going on with the housing market, not just from an interest rate perspective, but what's available out there for you, right? If I talk to some of our buyers in LA County or Orange County, there might be a little bit of limited inventory for them. And when I think about the housing market right now, it looks very similar in all parts of the country. Right now, we have not as much inventory as we would need to support buyer demands. While there's new construction that's available out there, from a resale perspective, there's just not as many homes available for buyers. Now, the reason for that is just many existing homeowners don't want to, get rid of their 2.5%, 3% interest rate mortgages they have right now. So it really makes it hard for existing homeowners to decide, hey, I'm going to go ahead and move up to my next house or relocate because I don't want to pay today's mortgage interest rate. So that's a little bit of a dilemma that we're in right now in today's housing market. I do think that will start to change over time. In fact, we're seeing a little bit of it right now. I think some sellers are getting a little bit anxious and saying, hey, you know what? I really do want to upgrade or I want to relocate. And now interest rates, which we'll talk about in just a bit, are starting to become a little bit more favorable, certainly not at the higher levels that we've seen. So when we look at kind of what's going on with the housing market here, kind of a little bit of a decrease. Some of that's just the seasonality of the markets. Generally in the housing market, we start to see an uptick in April and May. And that's kind of because, weather in most parts of the country is getting a little bit better. Buyers are now thinking about, what school districts they want to send their kids to, or maybe they're planning for what it looks like after the summer months. And so generally the housing market starts to get some traction in April or May. But what we found interesting this year is we didn't get a lot of traction until July or August, really. And I think the average consumer was kind of waiting to see what's going to happen with interest rates. And so you kind of saw this little bit of a delayed demand. And I will say, ever since we kind of got to July and August, we've really started to see some buyers pick up some demand. And I think a lot of that is now, I think we're realizing that we're in this kind of new normal from an interest rate perspective. So those that are thinking about buying are saying, well, gosh, I think if I'm going to buy, I'm probably going to consider buying now, because as interest rates drift lower, generally buyer demand does pick up. And if buyer demand picks up, but the inventory issue is still existent, then we probably will see prices rise to another level. And that's obviously something that, we're kind of considering right now as we're kind of designing plans for home buyers. Now, what's going on with interest rates? Just last week, the Federal Reserve announced a 50 basis point or 0.5% rate cut to the federal funds rate. And so, that obviously was all on the news. It prompted a lot of calls from clients and new clients to us. So I think it's important for you as attending tonight's class to understand what that means for you. So when the federal funds rate is cut by 0.5%, that's directly affecting your cost of your credit cards, cost of your personal loans, auto financing, personal lines of credit. So there's a direct correlation there. Now, it also has a ripple effect into mortgages, and we will see that hopefully in the next few weeks ahead as more considerations are made for future rate cuts. But what's interesting is with the Federal Reserve making those cuts, mortgage rates really haven't moved yet. And the reason for that is because a lot of what was expected of the Federal Reserve to take action on was already baked into the mortgage rates. So going into the Federal Reserve meeting last Wednesday, rates were still about 6%. Well, guess what? They're still right around 6%. So the Federal Reserve is projecting, or I shouldn't say the Federal Reserve, but investors are projecting 2 possible additional rate cuts by the Federal Reserve in 2024, and then up to 4 rate cuts in 2025. So certainly we're on a path forward where rates are declining. We'll have to see how low we go in interest rates. And that's a welcome change, because if you look at our snapshot of the screen here, going over the course of the last 12 months, in October of 2023, rates reached a 20-year high at 8%. They shortly there fell after that, and we see this kind of bumpy ride here that we've been all on. I'm glad I'm no longer on that ride, because certainly it did change affordability for a lot of buyers, and we're getting back to a level that's a little bit more attainable for buyers at that 6%-ish level. Now, many of our buyers that purchase at these levels here, the 7s to 7.5% level, are now looking at a thing called refinancing, where owners decide to refinance at a lower rate to improve monthly cash flow by ultimately lowering their monthly payment. So the question is, as we move forward, like what do interest rates look like? Well, the forecasts are for interest rates by the end of 2025 to reach 5.75%. I think with what could happen from the Federal Reserve, we could see rates go as low as maybe 5.5 by the end of next year. At least that's my own two cents on it. So we'll have to see what happens. It's a very fluid process at this point. Now, all interest rates aren't the same for all buyers. So that's important to understand. So credit eligibility plays a role, the type of loan program that you're going to elect, how much you decide to finance, what your down payment looks like. And then we talked a little bit about it earlier. If you decide to pay additional expenses out of pocket called discount points, that can also lower the interest rate for your financing. Now, so just a reminder, a discount point is 1% of your loan amount, and that 1% that you pay can generally bring down the rate about 0.25%. And then finally, a shortened term of your loan can also reduce your interest rate. So if you have a standard 30-year fixed mortgage, in normal markets, if you bring that down to a 20-year loan or a 15-year loan, that could potentially bring down your level of interest rate. So as we meet with clients to design their home buying plan, we're going to talk through interest rates, monthly budgets, and figure out what product it makes the most sense given your goals and objectives with home ownership. And then eventually, when you find the home that works for you, then we'll be looking at interest rates based upon that time in the market. Now, I'll kind of go off script here a little bit, which is locking in interest rates, because that's something that comes up in conversations with clients. So when you have an accepted offer with a seller, so you have a ratified contract, that's when interest rates are locked in for a buyer. So usually rates will basically change based upon the market. That's called floating the interest rate. But once you have an accepted offer, then you're eligible to lock in your interest rate. So if rates are today at 6%, but then by the time you find your house at the end of December, rates have dropped to 5.75, you would be at that level of 5.75 rate when you have an accepted offer on your home. All right. Okay, so let's kind of talk now. We're going to shift gears a little bit. I want to talk a little bit about the credit side of things, because when I think about our future first-time home buyers, there's usually two challenges that maybe kind of be in front of a first-time home buyer. One could be just lack of savings, just because I just don't have enough savings for down payment and closing costs, or it can be around a credit because maybe I'm a little overextended with student loans or credit card balances, or maybe I've had some past challenges around credit. So in our classes, we like to talk a little bit about credit and help give you some tools and resources to help maybe create better opportunity for you from a credit perspective. All right, in case I didn't mention this earlier when we launched into class too, if you do have questions that you want to kind of share with the audience, you can use the chat feature or Q&A, and then I'll kind of be monitoring that as well as Ken will, and we'll kind of pick up those questions as we roll through the content. So when we look at credit, there's actually 3 different credit models or scoring models for credit. There's credit card, there's auto financing model, and there's also a mortgage model. So of course, when you're applying for home financing, we're using the mortgage model on our side. When you're looking at your monitoring services offered maybe through Credit Karma or some of the agency monitoring services, they're also using a credit card model. So just kind of keep that in mind. So there can be some variation between that credit card model score versus what we could see on the mortgage side. So if we look at the mortgage score calculation, here's what the weighting looks like. 15% is going to be how long have I had credit. So the more mature my credit file is, the higher my credit score potentially could be. Then we have the use of new credit, which is 20% of the weighting. So what that means is, am I trying to open up new accounts? Do I have new hard inquiries on my credit? Those will impact 20% of the score. Now, in our process, if you decide to connect with us for a home buying plan, we only start with a soft credit check. And there's a difference between a soft check and a hard inquiry. And the soft check just gives us as a lender visibility to your credit score, doesn't impact your score, whereas a hard inquiry will stay on your credit for at least 12 to 24 months and could potentially hurt the credit score. 30% is going to be around revolving credit. That's looking at your credit cards, your personal lines of credit, comparing the revolving balances versus the revolving credit limits. Generally, we want to see those credit balances at least below 50% of the total credit limits. Now, if you're really trying to optimize your credit score, I would encourage you to have those balances below 10%. That should help you optimize your credit score. Now, I always like to kind of share with our class a tip on how to manage utilization. And that would be is that when you take some time to look at your credit card statement, there's two important dates on that statement. There's a statement date or billing cycle date. There's also a due date. So if you're in the habit of paying on your due date, that's totally fine. But if you could change things up and pay down or pay off your credit card before the end of the statement or cycle date, what's going to happen is you're going to get a lower balance that reports out to the credit agencies. And by getting that lower balance, you're going to improve your utilization and hopefully improve your credit score. Because at the end of the statement date is when the credit card issuer is going to send all the data out to the three agencies. And so if you can get ahead of that, that's going to give you the much more improved credit score. Now, there are three credit agencies, as we all know, right? There's Equifax, there's Experian, and there's TransUnion. Each will score things a little bit differently because their risk models look different. And finally, the last component is payment history. And that's kind of self-explanatory. That's how I've paid my bills, especially over the last 12 to 24 months. If I've had any late payments, they're going to be rated as 30-day lates, 60-day lates, and 90-day delinquencies. So the more significant or severe on the spectrum of late payments, if I'm at a 90-day delinquency, it's going to have a bigger impact to my credit score. Now, every loan program has a minimum credit score, and you can kind of see those on screen here. So not only will interest rate, possibly mortgage insurance, but the type of product will be influenced by what ultimately our credit score looks like. Now, when we've had bigger events like a bankruptcy or collections or short sale, those could have bigger kind of hits to our credit score. But as we get further away from those events, 12, 24 months, 36 months, we should start to see organic improvement in the credit score after those events. Now, some of our buyers will be looking to kind of optimize their credit by doing balance transfers and maybe, looking at other offers that are presented to them from credit card companies. Sometimes that will cause you to consider maybe closing out a credit card. Now, we would recommend not doing a closeout of a credit card unless you have significant credit card relationships out there and you have a good established credit history. Because when you close out a revolving credit card account, what it does is it takes away all the relationship history you have with the credit card issuer, and it takes it out of the credit score model. It also lowers the number of outstanding credit lines that you have available to you. So it can hit you in two areas on the credit score. It can hurt you from a length of credit perspective, but also amount owed and possibly lower your credit score. So just be careful before you close out any type of accounts. And in lending, we always look at all three agencies' scores. So we look at TransUnion score, Equifax, and Experian. However, we take the middle score between all three scores. So for example, if I'm at 760 is my top score, 740 is my middle score, and then let's say 720 is my lowest score, 740 will be the score that I use from a qualifying perspective. Now, if my partner also wants to apply on the application with me, they can certainly do that. That would be a joint application. But as a lender, I have to look at the lowest credit score between both borrowers. So if I know my middle score is, let's say, a 740 for me, however, my partner has a 700, 680, and 660 score. Well, the lowest middle score between the two of us is 680. So in that case, we would look at the 680 score from a qualifying perspective. And that's really important because that lower middle credit score will influence the interest rate, the product selection, mortgage insurance, the overall kind of underwriting guidelines for the home buying plan. So, and as we meet with clients, it's not about us just kind of sharing with you what your credit score is, but we're going to help give you some tools and give you some of our kind of expertise on what we think can happen in your credit score to help get some improvement. Now, negative items, can appear at different lengths of time on your credit report. So we thought we'd kind of pass along this little matrix for you to see how long things will hang on your credit report for. So more kind of severe things like late payments or public records. You can see late payments will be on your credit report for 7 years, but the impact to your score is in the most recent 12 to 24 months. So if you had a late payment, let's say in October of 2023, well, you're still inside of 12 months, so it's probably hurting the score a little bit. As we move past 12 months, you'll probably see some lift in the score. As we get to 24 months, should improve some more, but it will stay on the credit report as an image for at least 7 years. All right, before we talk a little bit about student loans, I just want to take a quick pause. Any questions from the audience? I know I've kind of given you a lot of concepts here, so I want to make sure that I address any questions that the audience has. Anything I can help answer before we talk a little bit about student loans? All right. Okay, if you do, go ahead and drop those in the Q&A or the chat, and I'll make sure I get those answered for you. Okay, we did have one in the chat. Okay, so one of the questions that came in, do you have any recommended, do you ever recommend opening credit cards? So possibly, it just depends on the situation. If you don't have a lot of established credit, I have a lot of clients, especially when we do our class for the international business class, they're just trying to establish credit in the United States. Sometimes it's a good idea to get a student visa through your bank, perhaps, or sometimes there's credit card, secured credit cards that you can get as well. So I think, it just depends on how many lines of credit you have. I don't think you need more than 2 or 3 credit cards. That should give you a healthy amount of established credit. And you just want to be careful that you don't want to add too many new credit cards, because that can impact your new credit that's being obtained and bring down that score. So there's kind of a little bit of a balancing act. I generally think 2 to 3 credit cards is completely sufficient. I know for me, I carry 2 credit cards. That's kind of what I do. But it makes it a little bit easier to manage. So I appreciate the question. Let's talk a little bit about student loans. Some of us on tonight's class may have student loans that are active. Maybe you have cancellation of student loan debt. Maybe you're in forbearance or deferment. So if you have cancellation of student loan debt, congratulations. Of course, we don't have to worry about that from a qualifying perspective. But if you're in forbearance or deferment, we still have to count a minimum payment for eligibility for home mortgage financing. So regardless if you're back in school or maybe they're still in forbearance, we still have to calculate a minimum payment. Now, if you're on an income-based repayment program, let's say you're on you have aggregate balances of, let's say, $75,000 in student loans, and your income-based repayment amount is $250 per month, we can use that for qualifying purposes. But if you're in that forbearance or deferment status, then we have to use at least 1% of the total balances, which in this example would be like $750 a month for a conventional loan. Or if we do an FHA loan, it would be $375 a month. So ideally, income-based repayment programs are, the best way for our clients to have a lower monthly outgo on student loans and help their qualifying. But everybody's situation is a little bit different. I think it's just important to know that even though you're not in active repayment status, we have to kind of still take those under consideration. Now, we have to do that consideration because every loan program has different guidelines as it relates to student loans. And so let's spend some time looking at loan programs right now. And there's obviously a bunch of different options available to buyers. So I'd like to give everyone kind of a look at some of the features and benefits of each one of these loan products. We'll kind of look at it from a high level perspective. But let's first of all talk about a conventional loan, which you may have heard of before. That's a loan centered around Fannie Mae and Freddie Mac loan products. There's guidelines set out for Fannie Mae and Freddie Mac. The minimum down payment for a first-time buyer using these programs is 3% of the sales price, as long as I'm financing anywhere between 765, 550, or less. Now, if I have to go above that amount, it becomes what we call as a high balance loan. And it does happen sometimes, especially in some of our Southern California markets, higher cost of living. It still has financing options, but when you go beyond that 766,550 number, the minimum down payment jumps from 3% to 5%. Now, every year, Fannie Mae and Freddie Mac sets the conforming loan limits based upon the cost of living. In fact, that conforming loan limit is going up, and actually effective right now, it's at just over $802,000 for the new conforming loan limit. So that'll change a little bit. That usually rolls out, 3 or 4 months before we end the year. So we already have that kind of implemented in place. Now, with the conventional loan product, there's a minimum credit score of 620. And when we put down less than 20% of the sales price and we use a conventional product, there is something called private mortgage insurance. And we're going to spend some time tonight talking a little bit about that. And the conventional loans are a big portion of the overall home purchases in financing. It probably occupies somewhere around 60 to 70% of all home purchases that are done across the United States. Next product is the FHA loan. It's not just for first-time home buyers. So a lot of people correlate FHA with first-time buyers. It can be for second or third-time buyers. FHA stands for the Federal Housing Administration. This product has a minimum credit score of 580, minimum down payment of 3.5%. Kind of follows in suit with most of the loan amounts for the conventional side, but it does vary a little bit for certain counties like Riverside or San Bernardino County. It looks a little bit different, but you can put a minimum down payment of 3.5%. FHA carries with it mortgage insurance regardless of your down payment. It's government mortgage insurance, and we're going to talk a little bit about that in just a second. We're going to do a little bit of a comparison to FHA versus conventional, but FHA will have a lot more flexibility in qualifying as opposed to the conventional product. And you can kind of see a little bit of that with the lower credit score requirement. And then the VA home loan is for our veterans that have eligibility. The VA home loan is there to help support our veterans in home ownership. Minimum credit score is 620. A lot more flexibility in expense to income ratios, credit scores, really to allow veterans the resources of home ownership. Also, it has a 0 down payment option. And for veterans that have any type of partial disability, the VA offers an exemption for the VA funding fee, which is usually like 2 to 3% of the loan amount. So the VA loan product is a great resource for our veterans that have that eligibility. And then there's the USDA loan product. Those are for clients that need to purchase in more rural areas. If you're purchasing out in the desert, perhaps, so let's say you really want to buy a place in Joshua Tree, right? So that can be considered USDA. It is a government insured loan. A little bit different than FHA. There's guarantee fees attached to the USDA loan that for buyers that qualify in those geography or in those geographical areas. They also need to meet certain household income limit requirements. And then finally, there's a jumbo loan. Those are for clients that need a little bit more financing. If your first house is going to be, above the limits for Fannie Mae and Freddie Mac, you might elect a jumbo loan. The difference is the down payments are going to be elevated for a jumbo loan. Credit score requirements are probably going to come up to 680 or so. There's also additional asset requirements that come along with the jumbo loan. So instead of saving up just for my down payment and my closing costs, we'll also need what we call as reserves with a jumbo loan. And reserves are additional funds that I have available to me above and beyond my down payment and closing costs. That reserve requirement is usually about 12 months of my total payment. So if I have an $8,000 mortgage payment, I may need about $96,000 in additional assets. Now, they can take the form of retirement funds, brokerage accounts, cash accounts, whatever the case may be, but there's some additional stipulations with the jumbo loan. Doesn't happen a lot for first-time home buyers, but certainly a resource that's available to you. Now, I mentioned to you, we talk a little bit about mortgage insurance because I get that question a lot. And so we like to kind of do a deeper dive in our class to explain to you what mortgage insurance is. So there's kind of two sides of mortgage insurance. There's PMI, which is private mortgage insurance, and there's mortgage insurance that's on the government side for an FHA loan. So let's kind of dive in and take a closer look. On a conventional loan, again, when I put less than 20% down, I do have mortgage insurance. Now, there's different ways to pay that mortgage insurance. There's monthly mortgage insurance where you pay it as part of your monthly payment. You could split the mortgage insurance up, half of it up front, half of it on a monthly basis. You can pay what we call single premium, where you completely buy out the mortgage insurance. Then you can also take an elevated interest rate in order to buy out the mortgage insurance. The number one option that most buyers select is monthly mortgage insurance. And the reason for that is because mortgage insurance, when you do a conventional loan, has a cancellation option that once I have 2 years in my original loan and 20 to 22% equity, I can apply to have the mortgage insurance canceled. Now, what I found in working with clients is that there's a little bit of a, it's a little bit misrepresented online when you're doing payment calculators, especially like on Zillow and Redfin. A lot of clients that are looking at scenarios with mortgage insurance see some really inflated numbers. And a lot of that is because the mortgage insurance calculators are not calibrated to some of the true characteristics that go into mortgage insurance. So PMI is going to be based upon what your credit score is, what your down payment is, and then how much you decide to finance. So the higher my credit score is, the more my down payment is, the lesser my cost will be in mortgage insurance. So we kind of want to share with you an example below that you can see on screen. For example, of a client that's purchasing with an amount financed of $700,000, they are at a 740 credit score and they're putting, say, 3% down. That mortgage insurance for that scenario is about $209 a month. Now, if that buyer's credit score is even higher, that mortgage insurance would come down further. So mortgage insurance can be less expensive and it can be a great way of putting less money down to purchase a home, and especially for a higher credit score customers, can be much more affordable than you think. Now, on the FHA side of it, it is government insured mortgage insurance for the FHA loan. There is two forms of mortgage insurance. There's an upfront mortgage insurance premium, which is 1.75% of the total loan amount. Then you also have to pay it on a monthly basis. So there's monthly mortgage insurance premium that's 0.55% of the total loan amount. And then we divide that by 12, and that's kind of how we come up with the dollar figure. Now, with an FHA loan, there is no cancellation option for mortgage insurance. So you really have to keep it for the life of the loan. Most of our clients using FHA are going to use that as kind of the bridge into homeownership. And eventually, when maybe their credit's a little bit better or they've approved and have more equity in their home, then they're looking to refinance down the road into a conventional loan to be able to maybe get out of mortgage insurance or lower their monthly payments by a reduction in interest rate. Now, if we look at the scenario in FHA mortgage insurance, take that same loan amount, we have now a monthly premium of about $320 a month, and the upfront MIP is $12,250. That gets added into that $700,000 amount financed. So FHA is going to be a little more costly than you would see on the conventional side, but to my point earlier, is going to give a lot more flexibility from an underwriting perspective. If you've already started searching rates online, for example, we can just Google rates right now on this class, but if you did, you're probably going to see the FHA rate a lot lower than the conventional loan. And so it's a little bit misleading online. You may say, wow, I want to do an FHA loan. But if you qualify for a conventional loan, it's definitely a better path to go down because you don't have the expense structure that you can see with mortgage insurance like you have on FHA. All right. Well, let's talk a little bit about income. That's obviously an important part of qualifying for home financing. I want to provide with you a little bit of a document checklist that you can see here as it relates to income, as well as a little bit of assets. So generally, for the buyer, we will need the last 2 years of W-2s, last 60 days of pay stubs or 30 days of pay stubs, last 60 days of bank statements. So that's generally what we're going to need. If you're self-employed, we certainly need to see the last 2 years of tax returns as we look towards qualifying. Now, in this segment of our class, I like to talk about different scenarios around income because, there's a little bit of, confusion, I guess, if you will, when it comes to applying for a mortgage. And it's really centered around the 2-year rule. So in lending, we have to verify at least 2 years of employment and or education. So one of the examples I use with our classes is like, let's say I graduated from UCI in the fall, right? And I just started a job January 1. Well, I'm technically less than 2 years on my job. However, since I've had that 4 year of educational background, that would help offset the 2 years needed for my home financing. So we don't even have to verify 2 years on a job. It's just your 2 years of education or employment history. I had a question in last night's class, which was, do I have to be on my job 2 years? So no, absolutely not. So if I've been on my job 6 months, but I can show 2 years of employment history, that's absolutely okay. Now, if I'm in a job role that has variable compensation, like let's say I have a base salary, plus I have, bonuses or commissions or maybe significant overtime, in order to count the variable sources, then I need 2 years on the job to be able to have us calculate it. But if it's simply just a salary position, then we can use that income as a source right away. Now, if you're a self-employed client, we do have to show 2 years of tax returns filed as either an independent contractor, sole proprietor, even a S Corp or C Corp. So we do have to see that as a 2-year requirement. Now, if I have other sources of income, like let's say I have a 40-hour work week job, but I also drive for Uber on the side. Now I can use that Uber income as long as I've been on my 40-hour work week job for 2 years, and I can show that I've been driving for Uber for 2 years, and then I can use both sources. That 2-year rule holds true with part-time jobs. So if I have part-time employment, have to show I've been on the job for 2 years. And if I have dual employment, like 2 full-time positions, I have to show 2 years as well. And finally, last thing I want to kind of touch on in this section of the class is just around maybe additional income that's in my household, but not going to be part of my application. So if I have a partner that contributes to our expenses, but is not going to join me on the application, then that income for your partner cannot be used in conjunction with the application. Even things like room rents would not be allowed in most programs that we offer. Now, we do take a look at income versus expenses, and that's called debt to income ratio. You may have heard of that calculation before. Really simple calculation. We're looking at pre-tax income versus expenses that appear generally on credit reports like personal loans, credit cards, auto loans, in fact, the new mortgage payment. Usually, we don't want those expenses to be more than 43 to 45% of that pre-tax income. So this is kind of what the calculation looks like. Takes into consideration the principal, interest, the taxes and the insurance for the mortgage, right? And the property, I should say. If I put less than 20% down, PMI will be factored in. And if I'm buying a condo, maybe a townhouse, or some of our single family homes that are in communities have HOAs or homeowners association dues. So I have that as kind of my housing expense. And then if I have other debts that are at $500 a month, Now I have $3,000 in outgoing debts. And if I'm making $8,500 a month, then that 3,000 versus my income is about 35.29% of that income. So that would certainly be well within the guidelines. And the question I get from a lot of our students in classes is like, well, where should that number be for me to feel pretty comfortable? And everybody has varying tolerance levels of that as a comfort zone. I would say the comfort zone from my perspective is like 33 to 36%, but it looks a little bit different for everyone. Again, the guidelines will allow us to go to 43, 45, even like 50% in some cases. But I think the most important conversation we're going to have as we build a home buying plan for you is talking about affordability. And affordability is one of our two big goals for homeownership. We want this to be an affordable opportunity for you, but we want this also to be sustainable for you over time. So if things happen to you or financially that impact your ability to pay, well, we want to make sure we still get ourselves into a really good position so it feels affordable for you from a homeownership perspective. All right, well, last segment of kind of building a plan in our discussion in class is going to be looking at down payment or savings for the down payment and or closing costs. So I want to give you a sense of like what's the typical documentation and some resources that are available to you. Now, as you look at down payment funds, you can use checking, savings accounts. Retirement can potentially be used. I would encourage you before you use retirement, talk to your financial advisor or tax advisor before you access those assets. Gift funds from family can also be used in financing. Now, most assets need to be at least seasoned 60 days, but gift funds can be transferred immediately from a family member. We have to paper trail those funds, but they can be issued right away. Now, as you heard earlier, like there's two usually challenges in a home buying plan for clients. It's usually on the credit side of things, or it's just savings for home ownership. So one of the things I like to share with our classes is just talking about a savings plan, right? And when we work with you on your budget, we're going to also figure out like what it's going to take to get you to your budget from an out-of-pocket perspective. So let me give you kind of a simple tip on how to create a discipline for savings and help you on that path towards home ownership. So let's say, for example, I'm paying rent of about $2,500 a month. But after meeting with us, you feel like, hey, I think I can set my monthly budget at $4,000 a month, right? So right there, we're lifting our outgoing budget by $1,500. So what I would encourage someone to do, if they're not quite ready from a savings perspective, but they are okay from a monthly perspective, what I would say is let's start paying ourselves like we're paying a $4,000 mortgage payment. So, and when we get a chance to, send our rent payment in at $2,500 a month, we create that discipline that we're actually paying $4,000, but $1,500 is going to our savings account on a monthly basis. And we do that, we're seeing that savings account, of course, grow at the end of 6 months, what we're at, $8,000-9,000 in our savings account. At the end of the year, now we've grown that to $18,000, $16,000 in growth, or in 18,000, I should say. And so you're seeing that savings account grow and start creating that bigger nest egg for homeownership. But it also does another thing. It creates discipline in that monthly payment. So when I get a chance to purchase, it doesn't feel like such a reach to get to $4,000, right? Because I've been used to saving that kind of amount of money. And that doesn't even include that savings account gaining interest too in a high yield savings account. So really simple practice that we can institute now, but it is super effective to help you on that path towards home ownership. All right, before we talk about first-time buyer programs, I'm going to grab a question in the chat. And question is, what is your thoughts in tapping into home equity to purchase a secondary property in today's market? So it just depends. I mean, some clients, will look to do that. They're, looking at potentially saying, okay, we want to take out a line of credit and then purchasing a second home or an investment property. I think it just depends on where that's going to put you at from a cash perspective and really what your goals are with that secondary property. Is it to create cash flow? Is it to buy something at a reduced price and turn around and sell it? It really just depends on what your goals are there. But love to be able to connect with you offline and talk through that a little bit. Okay, let's talk a little bit about first-time buyer programs. Since most of us are in California, we want to share with you more about the CalHFA program, or the California Housing Finance Agency program. We happen to be the #1 provider of the product line across the state of California. So really proud of this program. You might have seen this program in the news just about 3 or 4 months ago with the California Dream for All program. In fact, it was just back in the news a couple of weeks ago. Governor Newsom was talking a little bit about Dream for All next year. That Dream for All version is still kind of under construction. There, we don't have a really direction on that, but we're funding out right now the second wave of the Dream for All program, which was a lottery-based shared appreciation program. It'll help about 1,800 families achieve homeownership all across the state. We're proud to be the #1 provider of that too. That program is funding out now, so it's not currently available, but there's still other programs available like the MyHome Assistance Program. And MyHome provides up to 3% of your sales price in assistance for a conventional loan, 3.5% for an FHA loan. And what that is the state creates a separate loan for you at a 1% simple interest rate loan, and no monthly payments are required. In fact, you don't have to pay back those funds until you either sell the home or if you refinance in the future. So it's a great way of accessing cheap funds and then reducing your out-of-pocket expense. Now, there's also another program called the ZIP Assistance Program, which is a zero interest program of up to 2 to 3% of your loan amount. It is interest free. It is kind of an add-on to the My Home Assistance Program. So if a client needs resources, we start with My Home, and then if additional resources are needed, then we add the ZIP Assistance Program. Now, I will have to say the ZIP Assistance Program in today's market will elevate the interest rate. So the CalHFA mortgage rates are typically lower than the market rate, but when you add on a ZIP Assistance Program, it can push that rate up upwards of 1%. So in today's market where rates are already elevated, we don't necessarily recommend the ZIP program, but My Home is still a great option for our first-time buyers. So if we were to look at purchasing that $700,000 home with, say, a traditional conventional loan, we're probably going to need somewhere around $35,000 to $42,000 out of pocket. Now, it would include the minimum down payment of 3% plus our closing cost estimated at 2 to 3%. So for some of our first-time buyers, that might be a bit of a stretch, and that's probably on the 2 or 3 year goal plan, right? But when you implement a first-time buyer program, it can make it much more in reach. Maybe it's a 6 to 12-month plan. So if I was to institute like the My Home Assistance Program, now I get that full down payment covered, and then I really only have to worry about my closing costs out of pocket. So maybe that's 13 to 20,000. Maybe that's a little bit more attainable than the bigger number at 35 to 42,000. Now, since we're in California, and California is a high cost of living state, the income limits on these programs are, which you're going to see in just a bit, are much higher than typical first-time buyer programs. Now, a first-time buyer is someone that hasn't owned in the last 3 years. And so, with that, that's someone that could have been owned a house back in 2019, but have been renting for the last 3 years. You're still considered a first-time buyer. Each product under CalHFA has minimum credit score requirements. So for an FHA loan, the minimum score is 640. For a conventional loan, it's 680. And we talked a little bit about debt to income ratio this evening. Maximum is 45 to 50%, depending on a client's credit score. And how we look at qualifying income for the first-time buyer program, we look at only applicant income, not household income. So theoretically, if I make, let's say, $150,000 a year in income, but my spouse makes $100,000, well, the income limits in LA County are 194. If I can qualify in just my name, then only my income is considered into the calculation. Now, this product is eligible for 1-unit properties, so single-family homes, condos, townhouses, even manufactured homes, but the manufactured home has to be on land that it's actually owned. It can't be like a mobile home in a park. So here's those income limits for the program. So we kind of spotlighted Southern California since primarily most of us are in Southern California. You can see these income limits are actually 150% of the median income. So a lot more flexible, lenient, just allow a lot more inclusion for homeownership in California, given the cost of living. These income limits get updated every year. So right around May, June, we'll get the updated income limits, and I'm sure, of course, they'll go up again in the upcoming year. All right, let's talk a little bit about the buying process. So as we're getting towards the end of class, I want to kind of share with you like what comes next. So after you've attended a class and hopefully you love some of the information and resources we're sharing with you, the next step from tonight's class would be to get connected with us for a home buyer consultation. So that's a 30-minute session that we do together to design a home buying plan for you. That's a free service we provide to our communities to help support you in home ownership. Now, as we conclude one of those sessions, the output is to get pre-approved for home financing. And that's a no obligation opportunity for you, but a pre-approval shows a prospective seller whenever that time comes that you're eligible for your financing. It outlines your interest rate options, your loan amount, your sales price, expected down payment. That pre-approval is usually good for 60 days, but it can be always recertified at any time. So that kind of starts you on kind of the path towards home ownership. And that would move us along to house hunting. So a lot of clients, in fact, some of you in tonight's class have already been searching on Redfin or Zillow, nothing wrong with that. But now you would officially start house hunting. And that can still be done online, and then once you've identified a neighborhood or community or a particular home that you like, we would encourage you to go out and start kind of checking those places out in person. We'd also encourage you to get connected with a realtor. Now, we do have a network of preferred realtors across California and other markets that we serve in the country, but a preferred realtor is going to help support you, or any other realtor is going to help support you in negotiations, finding the right property that works for you, helping you get resources from and better understanding the community. Now, you may have heard that some of the commission laws have changed for realtors that represent buyers just about 3 to 4 weeks ago. So there was a lawsuit settled with the National Association of Realtors. So it changes how realtors are compensated. So, back in the days, it was just assumed that the seller was paying for the realtors, but that has changed. So realtors are expected to negotiate their commissions up front. So they have a buyer broker agreement that's executed with you. We'd encourage you to talk to a realtor if you do decide to pursue homeownership to get a better sense of what that looks like. Ultimately, that agreement just creates more transparency for buyer and seller about who's receiving what in the transaction, which honestly is a really good thing for homeownership. Now, if you find a home that you like and you present an offer to a seller, and let's say that offer gets accepted, well, then we're going to move to step 3. That's called entering escrow. So that's when a seller has accepted your offer and says, yeah, I want to move forward. You've successfully negotiated with the seller. Within about 24 hours of that acceptance, you're going to get a call from us saying, hey, congratulations. Now you have an accepted offer. Let's talk a little bit about timelines. And now let's schedule you for your follow-up video session. And that's where you and I will meet to kind of go through the redesign of your financing. Make sure we understand what current market rates look like, how much your out-of-pocket expense looks like, what are the timelines that we should be adhering to, all of those important things that are part of your home buying experience. And then as you as a buyer, you'll be expected to make what we call an earnest money deposit. That earnest money deposit is usually 1 to 2% of your purchase price. That is a good faith deposit that goes into the transaction, basically tells the seller that you have a vested interest in the success of this transaction. Now, that deposit is protected in most contracts by what we call as a contingency. And that contingency is anywhere between 10 to 17 days within your contract. So from day 1 to say day 17 of your contract, you have the opportunity to do all your investigative work on the property. That includes getting the house appraised, which as a lender, I would order for you. We would get your house inspected, which your realtor would help organize that. And finally, we would get your loan approved. So we would want all those things to be kind of checked off and met before our contingency gets removed. Now, that's kind of happening in the middle of this processing of the loan, which processing includes doing some of the administrative work. We're going to verify employment, verify like credit, assets. We're doing all kind of the background things to get you ready for the underwriting process. And that's step 5, where an underwriter is reviewing all the aspects of your application and validating everything. So that happens about in the first week to 2 weeks of the process. And once that underwriter has approved everything, and we get the appraisal back and your inspections look good, then we can green light the contingency removal. And that contingency removal tells the selling agent that represents the seller that everything looks good and you're ready to move to the final stages of the process. At step 5, as a lender, we issue to you a final closing disclosure, which basically gives you a 3-day cooling off period before we get to the final stages of the loan. And that's really the second time you'll have to be in person in this transaction, because everything is all done electronically in the mortgage space. You'll get 3 different iterations of disclosures in mortgage. You get the initial disclosures, you get what we call as a redisclosure once we lock in your rate or make any changes. Then you get a final closing disclosure at the very end for your 3-day cooling off period, just to make sure everything aligned and is really congruent in the process. And then finally, at step 6, you will sign documents in person with the public notary. That's also the same time that you'll be depositing your final funds for the home purchase. Those monies get reconciled with an escrow team. They'll also receive the loan funds that we're providing for you as your lending resource. And after that gets all settled up, documents get recorded with the local county recorder's office. They record a grant deed, which transfers ownership to you, as well as the deed for the loan. And guess what? After we get that confirmation back of recording, now you become an official home buyer, or homeowner, I should say. Not even just a buyer. Now you're an owner. I got a chance to make a few of those calls today. It's the best part of my day. It's a huge celebration. We try to make that experience for you a high touch experience, hopefully one that you enjoy. We understand it's a big purchase, and so we want to have the ease and convenience for you as you go through that experience and support you along the way. Now, you've heard me talk a little bit about what the next steps are from class, and so if you want to get connected with us for a consultation, whenever that time is, could be next week or next year, we just want to be a partner for you in home ownership. So it's a real simple 3-step process. You complete an online application. You'll do an upload of proof of income and assets, as well as schedule a video session with me. And I meet with all clients that attend our classes for that 30-minute session because I want to be a partner with you in helping design your home buying plan. So here's kind of what that plan looks like that we cover over. We'll talk about where do I want to buy, what's my budget look like? Are there any opportunities for credit improvement? Will assistance programs help support me? Do I have a really good understanding of the timeline of buying? And just set out some goals and objectives for home ownership. So whether you're looking to buy in 2024, that would be an ambitious goal, or it's 2025 or maybe beyond. We just want to make sure you understand what your resources look like for you on the path towards home ownership. So speaking of resources, we have a great mobile tool. It's our APM mobile app. You can download to start the application process. You can run calculations on mobile, and you can also follow the progress of your loan via mobile. So we try to embrace technology, but we're not losing the human touch side of things because we understand this is a big purchase for all of us here. And finally, we've talked a little bit about our UCI partnership and the discount that's provided and the resources like our first-time buyer classes. If you have friends or family, maybe even some coworkers that would enjoy these classes, they're generally open to the public, so they can check those out. We have probably 10 to 15 classes remaining on the calendar, but all classes are recorded and up on our YouTube channel. So if you want to look back at this class or any other past classes, we'd encourage you to do that. And as we get to the end of class, we're almost to the top of the hour, and we'll take some questions. Here's all my contact information. So if you want to get connected with me after class, feel free to shoot me a message. You can also follow us on our social channels at JMeda Mortgage. That's also our YouTube channel handle as well. We try to put good content on our Instagram, so we'd encourage you to follow us there. We're trying to give you all the tools that you need on this path towards home ownership. So I appreciate everyone being a part of tonight's class, and let's go ahead and open it up for some questions. I know we took some already, and I think a few of us are still hanging out in class. So what questions can I help answer for the group? And you can ask those questions by using the Q&A or chat function. Okay, I see actually a couple in here. Okay, we got that one. So question was, are there any down payment assistance programs if you exceed the income requirements for, say, for example, Santa Barbara County? There really isn't, unfortunately. Those are all set, and the CalHFA product set is the most lenient from an income limits perspective. If depending on your situation, I don't know if it's a dual income household or not. There might be ways to maneuver through the income limits if there's only one of you applying, but that would be the most lenient from an income perspective. Now, it doesn't change the fact that you can put the minimum down payment of 3%. It just might not be with one of the first-time buyer programs. Okay, that's good. Thank you for that. Okay. All right. Any other questions from the audience? Just kind of scrolling through the chat, make sure I didn't miss anything here. Okay. I think we did it, and I appreciate everyone's attendance tonight. Hopefully you had one or two takeaways from tonight's class that'll help you as you're making that decision towards home buying. I really do hope I get a chance to connect with all of you, and I hope you enjoy the rest of your Thursday evening and have a wonderful weekend. Have a good night.